information that you need to know. Welcome to Credit News, where we do a new show every single week. Today is episode one. Let's get right into today's information. So, first things first, guys, that you need to know. Number one is that Navy Federal is making a major change to the auto industry that a lot of people are going to start to see with other credit unions and banks. And here's what's happening. So now Navy Federal extends used car loans to 84 months. All right. So now, typically people are used to seeing not 5 months, 5 years, which is 60 months, or 72 months, which is 6 years. But now this is going into 7 years. All right. And not only that, but Navy Federal is kicking this off, but a lot of banks are now starting to offer, into that range of 84 months, 96 months. We're starting to see that increase. So Navy Federal extended used car financing terms to 84 months for eligible buyers right now. The credit union lowered the auto loan interest rates as ownership costs keep rising fast. Essentially, people are getting to the point where if they do keep a 4 year, 5 year, 6 year term, the payments are becoming astronomical. So they noticed that car ownership, the index rose 7.2% in May, showing that buyers are feeling the higher costs. Okay. So now what else does that mean? Used car buyers may get smaller monthly payments, this is going to mean that the 84-month used car loan spreads payments across 7 years instead of six. That can lower your monthly payments when vehicle prices and borrowing costs are high right now. Now, however, you guys got to think about this as well too. If you keep a loan longer, that means that the borrowers are going to keep paying on a used vehicle for much more time. Now, this is just an option. You can still go for 6 years, 5 years, or 4 years, but you're going to start to see more banks and credit unions start to do this more often. Navy Federal also lowered the auto loan interest rates. This is huge because typically you end up getting a higher rate when you have a longer term. But to be competitive still at that 84-month range is very difficult to do. So Navy Federal also lowered the auto loan rates during the same week, and the change appears aimed to be easing monthly payment pressure for used car buyers right now. Now, lower rates, of course, is going to obviously help you on the lower car payment side of things, but the total cost is still going to depend on the term that you get. So you don't have to go that 7 years if you don't want to, but obviously the size of the loan. So if you're going into that 50,000, that 70,000, $100,000 car range, this is you may want to consider. And then, of course, the overall pricing, which is the out the door. So you have the car, you have the taxes. If you add on any, maintenance or any warranties, gap, all of that is going to play a role into the final amount that you end up financing. So let me know your thoughts about that as you all are going through the car buying process right now. Have you all ever thought about going more than 6 years? Do you feel like that having a car loan that long is too long? Let me know inside the comment section below. Now, here's another thing that you have to keep in mind as well is that the auto industry is stretching affordability. So this is just Navy Federal. This is just Navy Federal making some changes in house. They saw that they were losing some car deals that people were not financing with them because they were not able to stretch the loans out longer. I know people are saying to themselves, well, why would you want to do something like that? There are some people who they have a certain payment budget. So they don't want to go 7 years. But in order for them to get to that $500 a month range, that's a huge difference, because you may end up paying $700 a month or more. All right. So the auto finance news says that lenders are lengthening terms to meet payment needs from buyers. Now, longer financing may improve the budget, but could increase the total interest paid over time. Now, how do we combat that? There's a few ways we can do this. You still can refinance your auto loan. Okay. You guys can refinance at any time. The sweet spot is after 24 months or so, especially if you have double digit interest rates. So keep that in mind. You also, this is just a minimum payment. We don't talk about this enough. When people hear the word minimum payment, they think that minimum payments is only when you are talking about a credit card. That is not the case. Okay. So you can most definitely be in a situation where you say to yourself, okay, I have an extra $20, I have an extra $100. Put that towards your auto loan so it goes towards your principal so you can actually pay off your car faster. You can do the same thing with mortgages, personal loans. Some personal loans have prepayment penalties, which means that if you pay in advance, so keep that in mind as well. But let me know your thoughts on this. But this move, it shows that affordability pressure is forcing the auto lenders to adjust loans again, just like they did, years ago when, 6 year loans were not a common thing. 5 year loans were not a common thing. 4 year loans were not a common thing. Okay. You got to go back in time. But as the prices of cars continue to increase, you can keep whatever term you want, but can you afford that monthly payment? All right. So again, you have to see what else is out there for you. Now, we also have some major news that's coming out that we're about to. So stick with me, and I'm going to show you guys something that's changing in the insurance industry as well. But the big warning for borrowers: an 84-month used car loan may lower car payments, but it's going to stretch the financial risk for buyers. Borrowers should compare the monthly payments with the full upfront costs. Okay, so make sure you understand what it's going to be if you keep that same loan term if you're paying every single month. But the real question is whether the car stays affordable across 7 years of payments. All right. Now, another thing that's going on right now is that Louisiana, they essentially are fighting to keep credit scores away from the process of getting insurance. Okay. So this is the second state in the last 8 months to try to ban credit scores from insurances. All right. So let's talk about that. So now Louisiana may ban credit scores in auto insurance. The lawmakers are considering a ban on those credit scores when they're talking about insurance pricing. So, what does that mean? That means that when you shop for insurance, people don't know this, but they run your credit to see if you're credit worthy. And then, based on that score, that determines the rates that you will pay. Why is Louisiana fighting for this? Well, Louisiana, if recently we talked about the states with the lowest credit scores. Louisiana is unfortunately one of those states. And so that means that they're paying higher insurance rates. And people were thinking it was because of weather related purposes. Obviously, that plays a role, but they also run your credit. So people that have better credit end up getting better insurance rates versus people who don't have the best credit. They end up paying more or higher insurance rates, and you have to keep in mind that you have the weather factors as well too. So now you're paying extra. But these consumer advocates say that credit scores should not determine insurance premiums today. Now, let me know in the comments if you think that that's fair. We're going to talk about this and how this affects people, because the proposal would also stop insurers from using zip codes to set premium prices. They're going by what credit scores that people have in a specific area, a specific zip code. Let me know if you guys think that that's fair or not. Because here's the thing: supporters say that driving records should matter more. This means that you should focus more on my driving record than what's actually the credit scores themselves. Okay. Advocates say that safe driving should matter more than credit history or what area I live in right now. They are arguing that financial hardship should not increase insurance premiums for drivers today. The proposal aims to focus more on driving behavior than their personal finance history. This means that if you have a medical bill that came out of nowhere, or worse, something that popped up on your credit report that really wasn't you, now your credit score drops, you're shopping for insurance, and now you're paying a higher rate simply because your credit score is lower. All right. So they're trying to essentially fight this. And I'm letting you guys know this is going to make a huge change nationwide, and other states will follow. Again, Louisiana is a second state. Now, here's the issue that they're going to run into. Insurance companies oppose the proposed changes. They're saying that credit scores help predict future claims and overall insurance losses. They're pretty much saying that people that have lower credit scores tend to make more insurance claims. Now, let me know if that's true or not, because I don't think it is. People, their credit scores fluctuate for various reasons. We had a client recently where they maxed out their credit card because they were paying for a funeral. Their credit score dropped. So who's to say that that person is going to make more insurance claims, or who's to say that this person is going to have overall insurance losses because their credit score is lower? I don't think that that's fair. They argue removing these factors could increase premiums for many other drivers soon. Now, the debate centers on fairness versus the industry's current pricing methods today. Okay, so let me know your thoughts on this as you all are shopping for insurance. Do you all think that it's fair for companies? They've been, and by the way, insurance companies have been running credit for years. Okay, they've been doing this for years. But is it fair? Do you think that they should continue to run credit when you're not borrowing money? You're not borrowing money. So again, I don't think it's fair personally. So I'm rooting for the state of Louisiana to fight this, and we'll see how everything goes. But the proposal is going to reshape the insurance pricing, not just for the state of Louisiana, but other states are going to notice this as well. If this is approved, insurers would need to change how many Louisiana policies are priced, especially based on credit scores. Companies would no longer use credit scores or zip codes when setting rates there. And supporters believe that this could create a fair insurance market for consumers because, again, you're focused on their driving history. Now, we talked about this some years ago, and this debate goes far beyond the state of Louisiana. Several states already limit how insurers use credit information during pricing today. Is it needed? I know companies want to do it, but you cannot say that a person is a bad person because they have a lower credit score. Like I gave you the example about the person that maxed out their credit card to pay for a funeral, or the person that had something pop up on their credit report and it really wasn't them. Okay. So supporters believe that more states could consider similar insurance reform proposals very soon. The outcome may influence future debates over fairness in insuring pricing nationwide. All right. So, again, Louisiana is most definitely trying to put some things in place here, and we're going to see how this whole thing, pans out. But listen, guys, that's today's credit news. And again, we're going to bring you a new show every single week. Let me know your thoughts on this. And we're also going to segment these videos. That way you guys know exactly what's going on. And listen, let me know your thoughts inside the comment section as well, too, guys. And we'll see you all on the next video. But real quick, Sledge says a 7-year used car payment is crazy, but you have to do what you have to do. Absolutely, Sledge. I feel you. And that's the thing, too. I think, again, we've gotten so used to 5-year auto loans, 6-year auto loans. And let's be honest, people have been, this concept has been around for years, right? And so, again, I think we've just gotten so used to it over the years that it may not seem like it's going to be one of those situations where, people may say, well, I can't afford this car payment. People still need cars. People still got to drive to work and they got to drive around, whatever the case may be. So, but we've been so used to 5 and 6 year loans when that wasn't always the case, I think in the 70s or 80s. So, as car prices keep increasing, it's only so much that middle America can afford. Okay. It's only so much that middle America can afford. And I think that's the bigger question. Are we going to slow down how much these cars are going to cost? But if materials keep costing more and people want to get paid more and inflation keeps happening and prices keep rising, people want to get paid more, it's going to be an endless cycle. Kind of like, I don't know what's the cheapest, Big Mac or Whopper you guys have ever seen in your lifetime, or let's just say a bag of chips. Do you guys remember when you can get a bag of chips for a dollar? Right now, you can only get two for a dollar, and pretty soon there won't even be those as an option. Okay, but when I was growing up in the '90s, you can get 4 bags of chips for a dollar. I know you guys know what I'm talking about. That's a perfect example of how inflation works. Is it fair? Is it timed perfectly? Not at all. But this is just letting you know that, hey, major things are changing, and this is why we got to keep up with those things as well. We got Ohio in the house. And Steven says, I agree. Driving records should matter more, not what someone's credit score is. I don't think that that's fair in any way. Shout out to Stephen Shelton. And of course, the Tesla T500 is here. Appreciate you guys being here, guys.